Happy New Year. Welcome to 2025. I want to start off this video by doing a quick recap of 2024. And then after we do our recap, I want to discuss a little bit about our projections for 2025 and where we see the economy heading and where we might see some opportunities for investors to allocate their funds. Let's dive right in. 2024 really turned out to be a tremendous year for the markets, especially for U.S. domestic equities. U.S. stocks led the charge amongst all other global asset classes. U.S. stocks did really, really well. The S&P 500 was up over 20% by the end of the year. It really did phenomenally. Even though there have been ongoing talks and a lot of media headlines saying recession, 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 we really just didn't see that happen. We've even talked a lot. If you watched some of my videos last year, I even personally said it is likely the economy is going to slow down just based off of the data we're seeing. And despite all of that data coming in, giving us very clear indicators that the economy is heading toward not a recession, but just an overall slowdown in productivity, that really didn't happen. The economy just continued to charge full steam ahead. And we saw the markets cool off a little bit toward the tail end of the year. The markets were down at the very end of the year, that last week of December. But otherwise, they really did phenomenally. And even with that as well, the Fed also had mentioned they were going to do some rate cuts throughout the year, which they did in fact do. And despite the rate cuts, interest rates still are very, very strong, especially in the fixed income space. Now, you might say, Ben, I noticed my high yield savings went down. I was getting 5% at the beginning of the year, and now I'm getting 4%. And you're right. We're not talking about cash assets. We're talking about fixed income or bond assets. Bonds have still done very well, mainly though in not so much in the treasury space, more so in the high credit corporate space. High credit corporate bonds are still doing really well. That sector for bonds approached almost double-digit returns last year, almost up about 10%. You can see some bonds that might have done 7, 8, 9% last year. And the yields have also stayed really, really competitive despite the rate cuts. So high grade corporate bonds right now, the margins on getting into that asset class is very, very tight. They're very, very expensive. I've been hearing from our research experts and our CFAs that they're saying, hey, we really expect this market to cool off. And they actually expected it to cool off in 2024, and it really just didn't. So if you were not invested in corporate bonds, but you were more concentrated in treasuries, corporate bonds really outperformed last year, and the income side of it also did really well. You can still get corporate bonds to this day that are yielding 5, 6, maybe even 7%, depending upon the length of the bond and the credit issuing of the company that's giving the bond. So a lot of really good things happened in the market. And I know we talked about slowdown, and honestly, the data still does suggest that the economy is starting to slow. Really, this is due to the labor market. Labor market numbers have really been tightening. Not as many jobs are available. And we're also seeing the wage gap sort of fill where it was. If you remember back in the pandemic and right out of the pandemic, wages were like through the roof. I mean, anyone could go find a job for $100,000, it felt like. I know that's not the case, of course, but that's just what it seemed like. It seemed like you could throw out a resume and you throw out one resume on Indeed and you'd get 20 phone calls back with 6-figure jobs. It was unbelievable. I had never seen anything like it. And we're not really seeing that as much anymore. The job market has definitely cooled off. So, but despite that, the economy really has chugged along very nicely. Some of the winning sectors, which surprisingly, the most winning sector in 2024 was not technology, even though the Magnificent Seven, which are all technology stocks, really led the charge last year. Patience, if you were in the communication sector last year, you would have done 40.2% in 1 year 2024 returns. 40%. That is unreal. If you had a $10,000 investment, you would have made $4,000. If you had a $100,000 investment, you would have made $40,000 in returns if you were invested in the communications sector last year. Some of our losers on the flip side, surprising, I think, to me, are real estate and healthcare. Real estate did about 5%, and healthcare did even worse. They did about 2.5%. So Those were really two sectors that if you were investing in the stocks, not necessarily real estate themselves or healthcare directly, I'm talking owning the stock to a real estate company or owning the stock to a healthcare company. If you own those stocks, they significantly underperformed other areas of the market, such as communications, technology, financials. Those are really the ones that led the way in 2020. So again, I wanted to give this quick recap. I hope this information helps. It's always good information for us, especially as financial planners, because it gives us a good indicator of where then we can tailor our portfolios to customize and say, okay, do we want to maybe shave off some exposure to communications and lock in some of those gains, right? It's always good to buy low and sell high versus, buying high and selling low. Knowing what sectors have done well and what sectors have not done so well gives us good insight on how to make better decisions. Transitioning a little bit to 2025 and what we're seeing, the conversation is still there to stay concentrated in US equities. The last few conversations that I've had with clients over the last week, because we're getting into the new year, prepared for tax season, folks are starting to say, hey, what can I do to prepare for my W-2s and 1099s and all that good stuff that are coming in, and how do I stay invested the right way for 2025? And the conversation has just really stuck to US equities. We had talked a little bit about international stocks last year starting to come alive. And even though international stocks did do well, some international stocks over a 12-year period were starting to get back into the double-digit returns. They just don't compare to the US stock market at the moment. The international stock market is still working to catch up to where the US is in terms of valuations, EPS, dividend growth, and yield, as well as just overall performance. So that's really where I think a lot of the conversations are going to lie. Any investments that I think most investors will notice that their US large cap and mega cap growth funds or investments will most likely do better than other asset classes they might have. This is not to say don't over concentrate and put all your eggs in one basket. It's just the trend that we're seeing, right? Diversity is still very, very important, but we're seeing the trends leaning toward the US large cap stocks and the mega cap stocks. Also with the fixed income space, I really do believe that the fixed income space is still very overpriced. I mean, to get a good yielding bond right now, you are going to pay through the roof. You're going to pay way over par to get that bond. Now, if generating yield is still very important to you, then it might be worth it for you to still pay that premium to get a good yielding bond and lock that in over a set number of years. But with that in mind, the margins are still very, very slim. And if the economy continues to do well, which of course I want it to continue to do well, if it does continue to do well and it doesn't slow down as much as we had initially thought or expected, then the margins on those high yielding, high credit bonds are going to stay very, very thin. So it's going to remain expensive to get into that space. Not that that is a bad thing. It's just going to make that asset class more attractive, especially to investors who already own it. If you're thinking about maybe offloading some of your fixed income for maybe US stock or international or small cap, or you just need to sell, you may want to consider how much you sell out of your fixed income, especially if you own that particular asset class of high grade, high yield corporate bonds. Those bonds are very, very nice to own right now. And you might want to sell somewhere else, maybe sell from another asset class that's done really, really well, and you're looking to lock in some growth like communications or technology. So that's really where I think we're going to be looking, especially when it comes to equities and fixed income. The treasuries are always tough. They sort of lag behind. Treasuries are one of those asset classes because they're considered risk-free, because they're backed by the US government. They tend to not always be as attractive as other investments, but on the flip side, there's no risk associated with them. And you may have heard something known as the risk-free rate, which the risk-free rate are the interest rates associated with treasury bonds, because that's the money you can get in the marketplace and not have any risk associated with it. So treasury bonds, I think, won't do as well as other yielding bonds like the corporate bonds or even municipal bonds. But if risk is something that's a concern for you, then treasury bonds might be the right choice for your portfolio. Again, it just all depends on what you want, what you're looking to accomplish. I think overall for 2025, we're expecting another good year. I'm not expecting a year like 2024 where we saw the S&P end, at 23% year to date. I think that was sort of a extreme year in a good way, of course, but I think to repeat that, not that it's not possible, I think the chances of that happening are just lower than the chances of it happening last year, especially as rates are continuing to be managed. Fed is still going to be very, very cautious about lowering rates too quickly. They already lowered rates, I think, a little aggressively in 2024. We'll see how that plays out. Again, I'm not saying that it can lead to a good situation or a bad situation. I just think they were aggressive with it. So they're probably seeing something that we're not, and that's okay. But the Fed is going to be very, very cautious about rate cuts throughout the year. They do want to lower rates. It's just going to be very, very dependent on the economic data that they're receiving. So with that in mind, I think the economy is still relatively fragile. It's going to most likely do well, but it's fragile. And the Fed is going to have to really be very sharp in managing rates and also managing the new administration that's going to come in and determining their policies and how that's going to affect the rest of the economy domestically as well as internationally. So again, a lot to talk about today. This is one of the longer videos, but my year kickoff videos are always a little bit longer. So if this is something you're thinking about, we didn't really talk about the incoming administration. We'll talk about that in the coming weeks, especially when Donald Trump takes office and he starts to implement some policies with Congress and the Senate. We'll talk about what that means at that time. Right now, it's all speculation. So I don't like to talk about speculation so much just because, again, it's a guess, right? It's an educated guess. It might happen. It might not happen. There's really no point for us to talk about it because if something we think might happen doesn't happen, well, then it has no effect on us. And if something we think may not happen does happen, well, then it does have an effect on us. Then we should talk about it and determine what that means for us on an individual level and how it affects our financial, retirement, and investment strategies. So with that in mind, thank you so much for tuning in today. We're going to be talking a lot more about our 2025 outlook in the coming weeks, again, especially as the new administration takes power. But I think really as a recap, 2024 was a great year and 2025, I think, will be another good year, especially for U.S. large cap and mega cap stocks, and also another good year or very attractive year for high grade, high yielding corporate bonds. So if anyone has any questions or they just want to understand a little bit more about how their portfolio is structured or some of the decisions that we're making at Vision Retirement of why we're making the investment decisions that we are and the recommendations we make, of course, you're always welcome to reach out to us. So thank you so much for tuning in today. I hope everyone had a very happy, healthy, and safe holiday season with their family and loved ones. And I look forward to a great 2025. Have a great one, everyone. Talk to you soon.